Well, luckily I know a little bit more about insolvency than technology, and we'll get the show running. So thanks for that. And I don't know why we are here tonight, because clearly insolvency appointments are 50% lower than this time last year. So clearly the economy must be flying. Clearly that's wrong. And for all the reasons that the panelists have mentioned today, temporary insolvency laws, ATO, banks' reluctance, government assistance has kept it running the game. Now, I'm not going to go through those again now, but what I will do is just highlight one of those temporary insolvency law changes and how that's important for accountants and their clients, because there's significant consequences. So there's temporary insolvency law changes coming into effect in March. They're meant to expire 25th of September. They've been extended through to the end of December, 31 December. Now, the one that I'm referring to is the protection for directors for insolvent trading. In this instance, if you put the company into liquidation prior to these laws lapsing, because they are only temporary laws, prior to the 31 December 2020, directors have protection from insolvent trading for the period of the time the law's in place. They leave it a day too long and they put the company into liquidation on the 1st of January 2021, they're liable for insolvent trading. So it's something worth considering, obviously, going forward for directors as to when they do or don't pull the pin. If they've got no hope, they might as well pull the pin now. We will get out of house arrest. Things will go back to normal, and we go from there. But your expenses are going to be tough. It's going to be high. It's going to be high. It's going to be tough. So if you flick the slide, thanks, Shane. Now, these are all obvious things that everyone else has spoken about, but it's worth repeating. People don't like being kept in the dark. Communicate with your stakeholders. They don't like surprises. So that's your banks, your landlords, the tax man, suppliers, employees, and seek advice from qualified advisors, your accountants, your solicitors, and your insolvency practitioners. When you do get that advice, make sure it's proper advice on the basis that you've got proper information. There's no use having books and records which aren't up to date, wrong figures, wrong information, wrong decisions. So that's just an introduction as to where we go. But how do you survive? If you flick this slide, Shane, we've got some options for people. How do you sail into the sunset? Well, there's three options there we're going to talk about tonight. One is safe harbour, two is deeds of company arrangements, and then the third one is Josh's reforms. So we flick the slides again. The first option is safe harbour. That was introduced in September 2017 and was meant to be reviewed after 2 years of implementation. Now, I'm clearly no good with computers, but I'm pretty good with maths. I can tell that 2 years have passed, 3 years has now passed. There's still been no review, but it's not the first time the government said they're going to do something that they haven't. The reason that the laws were implemented was basically people thought that by putting a company into administration and it was struggling, it cruelled the business and its chance of being restructured. So what Safe Harbour did was encourage directors to remain in control of the business that was in financial distress without the publicity, so it wasn't publicised, and it then protected the directors when they did it correctly from being personally liable for insolvent trading. Now, it's not disclosed, it flies under the radar. If you're listed on the stock exchange, you don't need to notify the ASX. So that was the introduction or the purpose for it. If we change the slide. So when does it start? The person or the directors in this instance, they need to develop one or more courses of action that are reasonably likely to lead for a better outcome for the company. Now, when we talk about better outcome, that means an outcome that's better for the company than the immediate appointment of an administrator or liquidator. Now, that course of action can be varied, it can be flexible, but it needs to be monitored on the way through. To qualify for Safe Harbour, if you flick the next one, Shane, there's a number of criteria that need to be met. The first one on the slide here is that you need to be up to date with payment of your employee entitlements. Included in employee entitlements is obviously superannuation, and that knocks out a hell of a lot of companies because, surprise, surprise, that's often not paid. The next thing you need to do is be up to date with your taxation reporting obligations. So not necessarily payment, but everything needs to be lodged. You need to be compliant with your usual director obligations, maintaining proper books and records and the like. And you also need to appoint an appropriately qualified entity. Now, there's no strict definition as to what that is, but clearly the most appropriate person would be a registered liquidator. They've got the experience, they've got the knowledge. And we talk about developing a course of action. as we indicated before, something that's going to offer more than what happens in liquidation. Now, whilst we indicated that safe harbour is not publicised, therefore we don't know how many have been done, how many have been successful, how many haven't. What we do know is that we at Dyneco have done a number of these engagements, a number of them have been very successful. I can talk about one of them just briefly, given that it did actually go into administration, which wasn't a bad thing. It's the Roger David group of companies, which if we had been appointed liquidators straight off the bat, the employees would have got paid in full, the bank would have got 50% of their money, and unsecured creditors nothing. So we oversaw a safe harbour regime which ran for 8 or 9 months. We oversaw a restructure process when the number of stores were reduced down from over 100 to approximately 50. Other measures were put into place, but it did come to a point in time where the course of action was no longer able to be sustained, and the most appropriate course was to then place the company into administration. The effect of all that, though, was that employees got paid in full, the bank got paid in full, and a deed of company arrangement was put forward whereby creditors got 15 cents on the dollar as opposed to zero. And the silver lining for the directors was that when the administrator does his report, he talks about the good, the bad and the ugly, what they get in a liquidation, and liquidators can recover insolvent trading. But in this instance, it was pretty easily determined that they did all the right things, they did their safe harbour and therefore protected for insolvent trading. So that's an example of where safe harbour comes into effect and is a good option in these circumstances. If you flick to the next slide, Shane, we'll compare that to a deed of company arrangement, which is a more formal process. So it's obviously publicised. The administrator takes control of the business for approximately 4 weeks. During that time, he runs the business, he trades the business if required, and does a review of its affairs, and then does a report to creditors. That report will provide the options to creditors as to what they'd get in the liquidation as opposed to what they'd get under the proposed deed. Now, the terms of the deed can be anything. If you don't mind just flicking the next screen, Shane. But certainly in this environment, a holding deed of company arrangement could come in handy. Certainly coming out of COVID-19, businesses aren't going to have magnificent cash flow, and therefore they might want to put a moratorium on debt for a period of time to enable them to get on their feet and then pay money down the track. Now, the terms of the deed, as I said, can be anything: payment in full, payment in part, payment in time, payment on the knocker. Now, obviously, creditors want their money too, and they're going to be needing money as well. So one of the options is, in respect of a deed of company arrangement, is to finance the contribution sum. So whether it be Stephen or Arthur, who both spoke earlier, or other financiers, both those two I know have the capacity to finance deeds of company arrangement, which means that your creditors can get paid in full. It's a much better sell, bird in the hand is better than two in the bush, and away you go. The deal is voted on by the creditors, and if it gets up and is successful, the management is returned to the directors. So they only lose control of the business for about a month when the administrator is running it, and then the deal gets through, they control it, and all creditors are bound. So that's an option to safe harbour, and we now have a third option. If you flick the slide, these are Josh's reforms. Now, these are just hot off the press, just been released, and clearly Josh has been a little bit lonely and a bit bored during isolation, probably sick of homeschooling, went to the garage, maybe to look for a hairbrush to relive the good old days, not too sure, but he stumbled over a dusty box, which was labelled Small Business Reforms 2014. Like all good politicians, he stuck his nose in and had a look and thought some of that had some good ideas, and he'd claim them as his own. So he retitled it, made some tweaks, and that's proposed now to be legislation on the 1st of January 2021. So it's based off some proposed amendments by a reader back in 2014. I say there on the slide there's been no consultation with industry bodies. I do tell a lie. An explanatory memorandum was released yesterday, along with draft legislation. We still haven't seen the rules or regulations that apply, and we have until Monday to lodge submissions to advise whether we think that it's a good idea or a bad idea. Clearly, it's a good idea. It just needs to be implemented properly, because this is permanent law, it's not temporary law. So you want to get it right, and things done in haste have habits of having holes in it, just like a piece of Swiss cheese. So it's important that we do get it right, and there's a very narrow opportunity for consultation. If you don't mind just flicking the slide, Shane. So to qualify, from what we understand, for this small business reform, and bear in mind, these numbers are based on the rules and regulations which haven't been released, but what we've been led to believe is the company to qualify needs to have liabilities of less than $1 million. The company tax lodgements need to be up to date, so that's your tax return and your BASs. Employee entitlements that are due and payable must be paid, similar to Safe Harbour. That includes superannuation, which may well knock out a lot of mum and dad type companies. It's also proposed as a protection mechanism that directors can't use this process more than once in a prescribed period of time, which is proposed to be, we think, 7 years. And if it's found that there is misconduct, such as Phoenix type activity, the process will convert to a full liquidation. If you flick the slide, thanks, Shane. So this is a debtor in possession model. What that means is when the proverbial hits a fan, the directors continue on and continue to control the business in the ordinary course of business. But what they do is engage with what's called a small business restructuring practitioner to implement a restructure plan. And they've got 20 business days to do that. Who can be a small business restructure practitioner? It's a mouthful. A registered liquidator is the answer to the question, although they are indicating that there will be a separate class created of a new registered liquidator who may have lesser qualifications, but we don't know because that's in the rules and regulations. So once the plan's implemented, that's sent out to creditors. The administrator charges a flat fee for that. He makes a recommendation to creditors together with a certification as to whether the business can meet these obligations and also whether the affairs of the company have been properly disclosed. If you flick again, thanks, Shane. So there's no meeting of creditors, similar to a creditor's voluntary liquidation. Creditors have 15 days to vote on the proposal, so there's no meetings. It requires at least 50% of creditors in value to vote in favour. Related parties aren't entitled to vote, another safety mechanism. And if accepted, it's the administrator that dishes out the money to the creditors pursuant to the terms of the agreement. If you'd like to flick that around too, thanks, Shane. So the proposals here were made because I thought voluntary administration was too costly and a little bit too chunky. So this is the solution. It's a more streamlined process. Interestingly enough, though, it's actually a longer time frame than the voluntary administration process. From a practical point of view, the major difference is that the director continues to control the business as opposed to in an administration where the voluntary administrator controls the business, runs the business, but he's also personally liable when he does that. So obviously there needs to be checks and balances in place. The question's going to be, are directors going to be personally liable for the debts they incur? And even if they are they going to have the capacity to pay? The bigger question though is, will creditors continue to supply the company, given that they've already had the company spend their money once and not pay it? Or will they require COD to continue the supply? So that's the question there, or the practical issues there. If you flick the slide again, thanks, Shane. Another new proposal is a simplified liquidation process. So it has the same qualifying criteria as a debtor in possession model in respect of less than $1 million, employee entitlements and super up to date, lodgements with tax up to date. If creditors oppose this process and 25% in value oppose it, it will revert to a full-on liquidation, not a light liquidation. This is meant to be a cheaper model in that the liquidator won't be able to pursue unfair preferences that can be clawed back from unrelated creditors. You won't be required to report to ASIC as much as ordinarily in the full liquidation. There are simplified voting procedures and simplified dividend processes and other cost savings measures is what is proposed. Good idea in principle, but the devil's going to be in the detail, obviously, going forward. So there are three alternatives available to companies in trouble. We know there's going to be a lot of companies in trouble. We were speaking to people in March who were in trouble and they've just kicked the problem down the road. Certainly look at the options. It's not a one size fits all. Different companies, different circumstances will require different solutions, but the key is to get advice and then make informed decisions. Thank you.